Stéphane Dess from Banque de France, head of Climate Economics Unit. And I'm very happy to chair this third session today with, again, 3 interesting papers. The first one will be presented by Margherita Giusio from the ECB. The title is Financing the Low Carbon Transition in Europe. And the overall theme of this third session is Financing and Hedging Climate Change. So let's start without further ado. And Margherita, the floor is yours.
Thanks a lot, Stefan, and thanks a lot for inviting me to this very interesting workshop today. So I have to say this is a joint work with some ECB colleagues, Katia and Dilara, who are also here in the audience, and Olympia and Sujit. And we completed this work at the ECB while working all at the ECB, so the usual disclaimer applies. So we're going to talk in this presentation how the financing of the low carbon transition in Europe works for firms that are subject to the European emission trading scheme. So let's start with some motivation. We know that in the EU, we set the goal of reducing the greenhouse gas emissions by 55% by 2030 and to reach carbon neutrality by 2050. And as you can see from this chart, we have done so far quite some work in reducing the emission, but the target is still quite far away. So we need firms to finance this emission reduction by investing more into innovation. And one of the main drivers of this emission reduction in Europe has been the emission trading system, which is a cap and trade system based on allowances that are provided or assigned to firms in high emitting sectors. Firms that have a positive balance are allowed to trade these emissions with firms that have a negative balance, so they emit more than what is allowed. And the price of these trades is the price of carbon in Europe. The aim of the European ETS is to reduce emission, but the long-term goal is to foster innovation in green technologies. And we all know that to do so, financing is very important. Finance in the EU, as opposite as what the last presentation actually has shown for the US, is mostly provided by banks. So it's very interesting to see how debt and leverage plays a role in the emission reduction of firms. We consider debt financing as total debt over assets, both provided by banks, but also by the bond markets. But as you will see, a lot of the firms in our sample are actually small and therefore mainly rely on bank funding. So the main research question is how debt finance of European firms relate to emission reduction in Europe. And we have 2 main questions. Here is a bit of a spoiler of our results. So we find that there is a significant relationship between the firm's capital structure and the ETS emission and emission reduction. And in particular, high leverage is associated with low emission, but only if the firm is has a low leverage. If the firm is too indebted, this relationship is not valid anymore. And we will explain what is the reason, our interpretation. Then we also exploit a regulatory change in the EU ETS in 2018 to understand whether firms that are subject to an increase in carbon price have reduced their emission more, depending on their initial level of leverage. And we find that firms that were subject to this increase in price have reduced their emission, but only if they had an initial low level of debt. Our contribution is, with respect to the literature, is mainly related to the data we use and the sample of firms. So first of all, we use the data provided by the EU ETS on verified emissions. So these are different from scope 1, 2, and 3 emissions, or ESG scores that we've seen also in other papers today. And we investigate the relationship between debt financing and the transition performance of firms, in particular distinguishing non-listed firms versus listed firms, SMEs versus large firms. So we exploit the heterogeneity of our sample. So let's start with the theoretical background and our empirical strategy. So to explain the theoretical mechanism that we investigate, we have to look at the relationship between corporate debt, investment, and low carbon transition, so emission reduction of firms. We focus on firms that are subject to this cap and trade system, so firms that face higher cost of emission and therefore have all the incentives to reduce them over time. So normally the innovation is financed via debt, via higher leverage. Unfortunately, what we cannot observe in the data is how firms decide to invest this debt, and in particular the split between green and non-green investments. If the firms decide to invest the increasing debt into green technology, then we expect to see a decrease in emission over time. While if the firms decide to invest in non-green technological change, then we would expect either the emission to stay stable or to increase over time, because this means that the economic activity of the firm increases, and this is normally correlated with the higher emission. So although our main variable of interest is not observed, we can sort of proxy or see the effects, the final effects on the carbon emission. Now, the literature on this theoretical mechanism shows that there are two opposing forces between leverage and investments. On the one hand, firms that have high leverage can invest more because of tax advantages and lower agency cost. On the other hand, if firms are very indebted or highly indebted, the interest expenses are also high, and they may have difficulties in raising new debt or new external financing in general, and therefore they may invest less. And as you can see in the chart, this is expressed in a convex relationship in which there is sort of optimal level of leverage that maximizes investment. After this threshold, higher leverage will not mean higher investments. So we test in our empirical specification 3 hypotheses. First, that high leverage leads to better transition performance, but only to firms that are on the left of this chart, that have sort of low leverage. For the rest, this will mean that higher leverage will not lead to better transition performance. And we test this on levels and on changes. And this is the difference between hypothesis 1 and hypothesis 2. And then in the third hypothesis, as I said, we exploit a regulatory event to see whether there is a group of firms that is too indebted for the low carbon transition because it's too leveraged and cannot invest in technological change. And for these firms, we may have to think of different policies. So now let's go to see the data set. As I said, we use the EU-TL database on around 3,700 firms from the EU between 2013 and 2019. And here you see the distribution, the geographical distribution. These firms represent around 25% of the European emissions, and these sectors are the high-emitting sectors, the ones that are subject to this regulation. In our empirical specification, we have 2 measures of transition performance. The first one is the change in absolute emissions, and the second one is the change in emission efficiency, computed as the ratio between revenues and emissions. It's basically an indicator of how much revenues the firms generate with 1 unit of emission. And why we use both is because a reduction in emission doesn't necessarily mean an increase in emission efficiency, because this is also related to economic activity and profitability. So So the empirical strategy, very briefly, for the first hypothesis, we use a panel regression with fixed effects estimation on the level of emission and the emission efficiency. And we, to investigate the nonlinear relationship between leverage and transition performance, we use the quadratic term of debt to asset ratio. We also include other drivers which indicate the economic variables or financial variables of firms, their environmental indicators, but also country-level controls, for example, the subsidy that states provide to high-emitting sectors. In the second, for the second hypothesis, we use a very similar regression, but with changes. And by using the threshold that we will identify in the first specification, we study the effects, the different impact of leverage on the transition performance of highly indebted firms versus low indebted firms. And the third specification is a Diff-in-diff analysis, in which I will explain the treatment and control group later, in which we exploit the change in the EU ETS regulatory framework. So here are our baseline results. For the sake of time, I will focus on the first two columns of these tables. Apologies if these numbers are too small, but I will guide you through. So we focus on the effects first of leverage, so debt to asset and the quadratic term on the transition performance measures, the log of emissions and the log of emission efficiency. And we see that there is a nonlinear relationship. So higher leverage is associated with higher transition performance if the leverage is below 50%. And we compute this threshold by basically computing the ratio between the two coefficients as explained in this slide. We also have all the controls that I mentioned earlier regarding the profitability of the firm, the age, the number of installation in the EU ETS, the cumulative balance of allowances, and the country-specific variables like carbon tax and fossil fuel subsidies. I will not go through one by one, but just to explain that this empirical specification gives also information on the relationship with other financial variables and environmental variables of the firms and the transition performance. So if we now investigate the change in leverage and the relationship with the change in transition performance, we see a similar relationship. So when leverage is above a certain threshold, 50%, a further increase in debt is associated with worse transition performance. And this is not true instead if the firm has a low leverage. Now, I will skip the economic magnitude just to explain that what we have seen before are just, estimates, coefficients, but we here also show that the effects, economic effects, are quite significant. So, as an example, if the firm has a leverage below 50%, a further increase in leverage of one standard deviation will lead to lower emission by 5% in the following year, and a better emission efficiency by 9% in the following year. So the economic significance of this change in leverage is quite high. So if we look at the Diff-in-diff design, we consider, as I said earlier, that in March 2018, the EU ETS was subject to a change and the phase 4 started, which meant an increase in cost for firms subject to this regulation. And our prediction was that the highly leveraged firms exposed to such change were unable to reduce their emission by contrast to the other firms. And what we find, this is the empirical specification. We show here on the transition performance the effects on the log of the emission. And our treatment is a dummy equal to 1 for firms that are highly leveraged and that are subject to an increase in carbon price. And we look at 2 years before and after the event. And what we find is that, indeed, firms that are subject to this higher carbon price and that are highly leveraged were unable to reduce their emission following this event. As you can see on the right, there is a clear gap between the control and the treated group. Maybe in the discussion, I can also mention the two robustness check that we do on the treatment and control groups. So to conclude, I will focus on the policy implications. What we find is that the EU ETS was indeed efficient for the emission reduction of firms that do not have a high leverage, but this is not true for firms that are highly indebted. And for these firms, we may have to find a different way to foster their low carbon transition. This has to do also with the access to transition finance, both in the debt market, bond market, but also in the banking one, because a large majority of the European firms is financed via banks. And the vast majority of the firms subject to the EU ETS are actually non-listed and small and medium enterprises, which are normally financed by banks. So for these firms, we may have to think of other instruments, for example, incentives for banks to lend for green activities or green projects. Otherwise, these firms may just exit the market. And so the EU ETS policy will not be efficient in making them reduce emission. So thanks a lot for your attention. I really look forward to the discussion and the Q&A.
Thank you very much, Margarita, for this clear and interesting presentation. So the discussion is by Ivan Ivanov from the Fed Chicago. So Ivan is online. Ivan, the floor is yours.
Thank you. Thank you. Right. Can everybody see it?
It's coming. Yes. Thank you.
Perfect. All right. Thank you very much for giving me the opportunity to read and discuss this paper. It's a really, really great paper. I learned a lot. So before I go any further, the views expressed here are mine and not those of the Fed. Okay. So the summary, I'm not going to spend too much time on this because you did a great job with the talk. But just to briefly highlight what we have in the paper. So the authors use data on EU emissions trading system, cap and trade program, to study the interplay between corporate capital structure and the cap and trade programs. So they have a large sample of firms. Most of these are non-listed, and their sample spans 2013 to 19. So the main findings in the study is that firms with higher leverage ratios tend to reduce carbon emissions to a larger extent. So now that's a key finding. And what they show is that, along with that, emissions efficiency improves as well. And that these results are concentrated within among the non-listed firms. Sorry, that's a typo on the slide. They also find that highly indebted firms are unable to fund low carbon transition, where they define high leverage in terms of different cutoffs. More than 50% is the most common one that they use in the paper. And another key finding, the final key finding in the paper, is that they don't find evidence of much use of green finance to fund this transition. Okay, so I think the paper is very important, and I think we need to know these relationships to learn how to regulate the space in terms of the cap and trade programs. I think these findings are also important because firm leverage is highly pad dependent. So the starting point at which firms get regulated or at which they enter the cap and trade program is important for the outcomes of these firms that we see afterwards. So my main comments are along a few lines here. I just have some questions about the sample selection and how maybe the authors could do additional tests to learn more from the panel regs. I also have a number of points on diff-in-diffs in the paper and basically how we can beef up the interpretation of what we find and how we can actually get more like insight about what this means for firms in the sector. And then like my final points relate to how we should view this study related to other studies in the same like space, and maybe something like the authors could do in the writing to like emphasize the contribution. All right, so in terms of the panel regs, I like this approach of just going back to the basics and trying to like figure out how leverage is associated with future emissions for the firms that are subject to the cap and trade programs. I think we learn a ton from the paper already. I mean, the author shows that these associations are much stronger cross-sectionally than in the time series. So what like stands out here is that we need a little bit more evidence to like attribute this purely to the leverage effects rather to some other types of effects such as access to capital markets or maybe financial constraints. So what I have in mind here is that more constrained firms maybe more leverage, maybe they'll have less leverage. It's just like not as clear, like it's not as clear ex ante, right? On one side, you could have like financial constrained firms being less levered because they're not able to borrow, but then from another side, I think they may not be able to unwind leverage when they're faced with adverse shock. And so what I worry about here, like specifically, is that the leverage emissions relation could have less to do with incentives to reduce emissions than with the ability to do so. So this is something the author should like explore. So now the listed non-listed firm split alleviate this concern to some extent, but we need to see more tests. I recently saw an ECB paper as well that basically showed some really interesting evidence on how like smaller non-listed firms in Europe have access to bond markets. So they're not borrowing just from banks here, and even if they are, I think it would be interesting to see how many banks they borrow from, whether they have any outside options with other lenders, and the role of the bond markets here. So I think this should be straightforward to see if these data are available. So and I think it would beef up the claims in the paper. Now, I wanted to see more in terms of the controls in this panel regression. So I want to see more of what's used like in the standard leverage work out there. I think like in terms of size, most studies would account for size with total assets, employees, because revenues may not be as good of a measure of size. And I think you cannot include revenues in the emissions efficiency regs as well. So I think that will be important to do here, because size is by far the most important factor that is associated with a leverage rate ratios. I think another thing that I would like to see here, which is not in the regs right now, is some measure of growth options. Yeah, we don't have that, and I think that's also important, goes hand in hand with leverage ratios. I think, I mean, both of these things should be fairly easy to do. Okay, so the second point that I have is on the Diff-in-diffs. I just think that we need to like go simpler here a little bit, because right now treatment comes along two dimensions: excess leverage ratios, which is greater than 50%, or emissions permit shortfalls. So these two tend to interact with each other, as you found in your earlier results. So I think like one way to make things simpler here is just to define treatment in terms of emission shortfalls, and then you can split the sample along whether firms are highly levered or less levered. But I think this would be important to do, because I think we need to see what the effect of this rule changes also on the firms that emit, but that are basically less levered. Now, another thing that would be interesting to see, and I think it's important here, is that the 2018 change could have been anticipated based on the path of these regs in the EU. And so what I worry about this, like specifically, is that both traded and the control firms may have responded to the rule change at the same time. So in the chart you show, like, we're not able to see that because you have like the difference in responses. Okay, so I have similar concerns here about the inclusion of like size and growth options, measure of growth options in the Diff-in-diffs. And then I think it would be useful to also like compare emitting to non-emitting firms. And I think you should be able to easily get data on non-emitting firms, just to rule out the fact that there could have been other like market-wide shocks that affect all firms in the sector, and that's why we see the effect along the leverage dimension. But yeah, so this should be fairly like straightforward to do too. Okay, so my final comment here is on the interpretation related to other studies in the space. So you have like a number of newer work on like a cap and trade program. Some of this evidence comes from the US, so I would like you to talk about this. I know that in Europe, the regulations are more stringent than in the US, because in the US, such regulation is not enacted on a large scale. So I think you should talk about like what we learned from this study and how it relates to like findings of other work. And then this other paper that I'm quoting here, Dalis et al. I think that paper looks at cap and trade, as far as I remember, for Europe. So I just want to like learn a little bit more. What they look at is bank loan rates. So your study is very different from theirs, but I think it would be nice to talk about how the channel that you have in your paper, disciplining effect of leverage, reconciles with the financing costs, with the higher financing costs that other studies have found in the context of a cap and trade. Okay, so my final comment is here is basically how do emission exports like affect your results? Like, we know very well that large firms have incentives to export like emissions to less regulated jurisdictions, and we also know that a lot of them do so. So I think this is something you should talk about in the paper. You have some results for listed firms that are not very strong, so that could actually support this idea. But I think a little bit more is needed here, and basically how it affects your results as well. So that's all I have. It's a really cool paper, really nice paper. I think it would be like an important paper in this space, because it talks about a very important channel that we need to know when we regulate going forward. Thank you very much.
Thank you very much, Ivan. Margarita, do you want to reply quickly to leave some time for the questions?
Yeah, very, very briefly. So thanks a lot, Ivan, for this very nice discussion. We will really benefit from it. So very briefly on a few points. On the access to capital markets in particular, we checked that, and in particular with the issuance of green bonds. And unfortunately, our sample really shows that these firms do not have access to the bond market. Very few firms have indeed issued green bonds. If I remember correctly, 36 throughout the whole sample. So any regression on those would not be that significant. On other financial constraints, we will think about it. If you have ideas on proxies, that would be really helpful. On controls, the total assets, unfortunately, this is it's part of the definition of the leverage. So we would not use it because of that. But we can think of the number of employees just to measure in different way the size of the firms. On the Diff-in-diff, we don't see any sign of anticipation or at least any difference between the treatment and control group in that. So I'm not sure how else we could test this. But yeah, your suggestion on the splitting the sample into low and highly leveraged firms and then use only as a treatment the emission shortfall, I think we can add it in a robustness check. And on the interpretation, I mean, this is a point well taken. We will maybe relate it better to that literature. This is very useful. Thanks.
Thank you, Margarita. So we have some time for questions. Yes, please. Chat also in the meantime for those online.
Thank you very much. Thanks, Margherita. Very interesting paper. A couple of remarks / questions, suggestions. The first one on the missing link that you have in the paper, right? This technological investment that you do not observe. Have you considered looking into green patents that are potentially issued by ETS firms? Because there is quite some literature out there showing that actually ETS firms who are facing higher cost of emissions were in a way forced to innovate into the low carbon technologies, and this is evidence that is there for cross country of EU member states, but also for the UK. So maybe getting this additional channel would be also very informative for policy, you know, because we know that the 2015 targets will not be reached without substantial technological innovation, and uncovering the financing channels is pretty important. The second point was related a little bit to what Ivan already had in his slide, and you practically replied when you said that you do not observe issuance of green bonds. So indeed, whether you can zoom in on different type of financial instruments when you consider leverage, or if you want the flip side of it, whether particularly your small and medium-sized enterprises in the sample are, for instance, those that can tap the private equity or venture capital funding sources, and still clearly, I still have in mind here firms that are, if you want, on the technological frontier for low carbon innovation. Thank you.
Yeah, thanks a lot, Serena. Both very good points. On the number of patents, I think we can add it as a proxy as well. I think what we will miss is really sort of the amount of debt that is invested into the green. So this could be definitely a proxy we can think of including. And on zooming into the different debt instruments, we do that in the paper only on green bonds in particular. But yeah, we can exploit other data sources to also look at private equity and venture capital. I don't know if you're aware of any data that could be merged at firm level, but maybe we can discuss it later. Thanks.
We have another question from the room.
So I guess it's part question, part comment, right? So, implicit in your analysis is that the market is not working, right? That there's something here which is somehow not really playing out the way it should. So I can't help think when I listened to what you did and what I saw your 50% leverage thing, right? So you have essentially all the ingredients to do a Tobin's Q approach, right? Where if I was Tobin, I would say to you, that's okay, right? Because if you raise the price of something, I have a highly leveraged firm with limited growth potential. I shouldn't refund you. I shouldn't refund it. It shouldn't be allowed to continue. It should go away and not bother me anymore, right? So I really think you should think about you have the variable with growth opportunities, you have all the other ingredients to do the Tobin Q check. Because I would suspect that exactly that point would maybe give you an alternative route to understanding why is it that at some point leverage becomes too much, right? I think that you might find a stronger story in that, because if you have high growth opportunities and high leverage, you're still fine, right? So there's a bit of an issue with it's 50% for everybody. If I was Tobin, I would disagree with you, right? Yeah?
But I see this more as a policy question, or a question for policymakers, right? Do we want highly leveraged firms that are in high emitting sectors to just exit the market? Because the way I see it, it doesn't have to be like these firms that have a high potential but are highly leveraged. They do not necessarily have the ability to increase further the leverage and invest in the transition, right? So it doesn't matter the growth potential. They are in sectors that are subject to this higher cost, and therefore they have to reduce their emissions, right?
Sorry, yes, but this is in a second step, right? First, I want to know, so the market will handle some of them, right? Because they have low growth potential, they're highly leveraged, they'll go away on their own. I don't need to worry about them. Then you can have the view, okay, I still have some left that have high emission, high debt or high leverage, and high growth potential. Now, so then the policy question becomes, should I still go out and do something about them? But I'm just saying there are two groups, right? If in a Stark world, right? This is obviously a continuous variable point, right? Mm-hmm. But at some level, the question for me is, I can't tell from what you've done how many will die by the market's hand in and of themselves, right? Because how many are left in the bucket when you're done with the... Mm-hmm. Do you understand my point? So I agree there's a policy discussion to be had, but before you know how many you need to kill, it'd be good to know how many they are, right? I mean, you don't know, right?
No, but so the point of view that we take is slightly different. It's like on emission reduction, right? So but I get your point. Yes. So how do we finance the one that at least have a high growth potential? Yeah.
That's a different
conditional, though. So we are not talking about here, for example, on the economic impact that this exiting of these firms can have on employment and so on, especially if these are concentrated in some sectors. But I get it. Thanks.
Thank you. I'm afraid I should stop this very interesting discussion.